Here are the top 5 worst type of stocks you can invest in. Before we dive in, if you guys like videos on investing in finance, please hit that like button. If you want to see more videos like it, please hit that subscribe button. Here at Tykr, we're all about clear, confident investing. Okay, we'll go in reverse order, starting at number 5, which is REITs, real estate investment trusts. So investing in real estate is a great place to be. I have a lot of friends who invest in real estate. I've also interviewed a lot of people on my podcast, Payback Time, that have talked about how they make money with real estate. Now, a lot of people start small with like single family or duplexes, and they kind of work their way up to like 4 units and 8 units. But the most successful real estate investors by a long shot invest in what's called syndicates. A syndicate would be like a private entity that has like 100 units, 500 units, 1,000 units. And the typical return you can expect with syndicates is about 10% per year. But if the syndicate is purchased by, let's say, a larger syndicate or a private equity firm, you get a windfall payday event, which is a great place to be. Now, there are people out there that are like, I like to invest in real estate, but I go through REITs in the stock market. Well, historically, they have proven not to generate the best results. So I did a little homework and I found an article from usnews.com. It actually lists the 9 best REITs to buy in 2024. So I did a little homework. And what I like to do in Tykr is I set my charts to 5-year. And for context, the S&P 500 usually returns about 80% over 5 years. So if you're ever looking at an asset class or a stock, it's nice to look at what are the 5-year returns. Did it actually keep up with the stock market? Again, 80% is the benchmark. So check this out. Here are a few that are on that list of the 9 mentioned. So Prologis has returned about 44%. American Tower has returned negative 4%. Welltower has returned about 29%. Most of the REITs I find in the market don't even keep up with the S&P 500. I want to step further and I'll show you Tykr here. Check this out. I went to the stocks page, and then what I did is I went to industry and I typed in REIT, checked every box that had something related to REIT. So you can see your diversified, healthcare, hotel, industrial. I wanted to see everything. And it brings the list from about 40,000 stocks down to about 614. And then I went to this column here, 5-year returns. And actually, I'm going to arrange my columns a little better so you guys can see this a little easier. Here we go. So 5-year returns I put right here. There's one here that has returned 10,000%, like very rare. You never see that. Then I see one here for 700%, 581, 247, then 157. And then here we go, 84 on down. So there are only 1, 2, 3, 4, 5 REITs that have beat the market. Out of this 614, the majority don't even keep up with the market. So again, if you guys like investing in REITs, that's fine. Just set expectations. You're probably not going to match the market. You're better off investing in real estate directly or investing in a syndicate. Okay, moving on to number 4 would be pharma stocks. Now, pharma, yes, you can find those pharma stocks that can return like 1,000% over the next year or two, but it's very rare. They're very risky. The reason is one government regulation can cause a pharma stock to tank overnight. Now, I'm going to talk about another category here in a minute. When I talk about pharma, I talk about anything that's medication. We'll get to another category here that is related, but any kind of medication, keep that in mind. One government regulation can cause a pharma stock to tank overnight. And also keep this in mind. I have friends that work for large financial institutions, and some of their roles include building index funds and ETFs, essentially putting together a bundle of stocks into a fund and then naming that fund. Well, they are instructed. For example, this was one example. I was talking to somebody who was an analyst that said, hey, I was allowed to construct a fund that had like 500 stocks, but my boss told me I better not see one pharma stock in that entire list. Otherwise, you're running into a position where you could lose your job. So that even tells you even analysts aren't allowed to add pharma stocks to funds. Not all funds. I know some might be pharma focused, but it's just a very risky asset class. So keep that in mind. I know, again, some people like to go for those high flyers. They're looking for that new hot pharma stock that It's a medication that can change the world. It's very risky and very rare. So just keep that in mind. Give you some examples here because I like getting to the numbers. S&P 500 returns about 80%. Here are a few. Merck, big name in pharma, has returned about 74%, so it hasn't even kept up with the market. You have Novartis, which is about 32%, Sanofi, which is 16%, and then Gilead at 3%. Not very good. So set expectations. Pharma, sure, you can invest, but in most cases, they don't keep up with the market, and it's very risky because of government regulations. All right, moving on to number 3, which is Medtech. Similar to pharma, but when I say Medtech, I'm talking about medical technology, physical equipment. Same situation, one government regulation can cause these stocks to tank overnight. However, there are a few outliers. So Intuitive Surgical, we're going to get right to the numbers here. So Intuitive Surgical has returned about 148% over 5 years. Again, S&P is about 80%. So that's really good. And then InMode has returned about 179%. Then you have Edwards Life Sciences, which is about 55%, so it doesn't keep up with the markets. And then you have Medtronic, which is about 3%. So I did a little searching for medtech stocks. Most, again, do not even keep up with the market. Again, you can be tempted. You might hear somebody talk about that new hot medical technology that, again, could change the world, and people will pile into that. But again, very risky. You can lose a lot of money. All right, moving on to number 2 would be travel stocks. So I look at travel stocks as more of a want to have, not need to have. Like when I invest in businesses, of course, I'll jump to Tykr here, showing my screen. A hot stock that everybody's searching for today is NVIDIA. NVIDIA, if you guys didn't already know, here in Tykr, it's got 100 out of 100. Getting to 100 is very rare. I only see about 10 stocks at a time get there. They have very strong financials, but I look at NVIDIA as more of a need to have because semiconductor chips are in everything. We're talking computers, refrigerators, cell phones, even cars. They are a necessity. So if anybody says that, NVIDIA's a flash in the pan, meme stock, no. A lot of semiconductor chips are in high demand, and NVIDIA just happens to be leading the pack. So this is more of a need to have, whereas there are stocks out there like travel stocks, more of a want to have. And of course, as the market does pull back, travel stocks can really take a big hit. But again, let's go to the numbers and really see what they say. So some of the popular travel stocks out there include TripAdvisor, which has returned negative 58% over 5 years. Norwegian Cruise Lines is about negative 69%. Carnival is negative 69%. Expedia is negative 2%, but there is an outlier here, which is Bookings Holdings. They're at 115%, so they do beat the market, but very rare. Most travel stocks I do avoid. Again, they fall into more of the want to have than need to have. All right, and then moving on to number 1, which would be airline stocks. There's a famous quote I heard years ago, and I laughed out loud right away when I heard it, which is, you want to know the fastest way to become a millionaire? Start as a billionaire and then invest in airline stocks. See how that works out for you. That's the fastest way to lose money. Airline stocks, very risky, a lower profit margin. I love traveling. I get it. I want to be in a safe plane, but would I invest in that airline? In most cases, no. So here are the numbers. So Delta Airlines has returned negative 2%, about negative 2% over 5 years. United Airlines about negative 33%, American Airlines negative 53%, and Southwest Airlines negative 45%. Again, I love traveling, but would I invest in an airline stock? Absolutely not. All right, if you're looking for clear, confident investing, I invite you to join Tykr for free. If you're looking for free training, I do have a webinar titled The 3-Step Investing Plan to Buy Stocks with Confidence. You can go ahead and see that below. And I hope you check out the next video. Bye for now.